What's going on, guys? We are going to talk a little bit about today's NASDAQ 100. And the reason we're going to, talk about today, I haven't made a video in a while, just due to the fact that normally at the end of the year, I kind of start to reconcile my books. Trading futures and prop firms is not the only thing that I do. I manage a portfolio. I sell covered calls in my portfolio. I've got some long-term holdings. I've got what else? Some, other just dividend ETFs and stuff like that. So I kind of try to shuffle some things around, kind of see what I'm going to allocate going into next year, what I'm going to hold, what I want to clean up. And for me, it's kind of like a risk off situation. And when you translate that into day trading futures, if it's risk off from more so an investor's standpoint, the price action for day trading is going to be hit or miss. It's going to be hot or cold. Like, so for example, if you got in short today and you kind of just held on, you made some money, but you guys will notice it's also volatile. The market's really not doing anything. It's not like we're making new lows and the market's not pushing towards all-time highs. So when you get in a little bit of this volatility, range bound chop action, you're going to get those quick moves. But with those quick moves also comes getting stopped out, right? So you get short, it bounces a little bit, you get stopped out. You think that it's going to bounce some more, and then the market kind of sells off. So if we kind of look at today's price action, today being December the 8th, it's currently 12:30 Pacific Standard Time, so market's going to come to a close right now. Off the open, we had a huge spike, okay? Now, what I've been noticing for about the past month, maybe even 2 months, I'm trying to stay out of that first opening range candle. Now, I haven't done a great job at that, meaning there's been some days where I've been able to catch that opening, that opening print candle, make some cash and then just have the discipline to walk away. But what I'm really noticing is that if you can kind of just stay patient a little bit, 5, 10, 15, 20 minutes, you're going to start to see the bigger play start to unfold. And if you look at the opening drive here, we had a big, huge spike off the open, okay? That did close over VWAP. It closed over all the moving averages, 20 SMA, so forth and so forth. However, there was no confirmation of a continuation to go higher. So when you fail to continue these highs, especially after the top of the hour, come that 10 a.m. Eastern hour, you have to start looking and thinking to the downside. Now, here's where things can get a little hairy and things can get a little bit dicey. Because of the range, and if you look at these 5-minute candles, you're talking ranges of 32 points, ranges of 80 points, a range of 85 points, 44 points. You're going to have to size down the number of contracts that you're trading, or you're going to need to switch from minis to micros, because the bigger picture here is saying if we cannot confirm the high, if we cannot stay trading over VWAP, if we cannot stay trading over the 20 SMA, the momentum is going to drift to the downside. Now, where traders are going to get into trouble is because, let's say, for example, maybe they are on the right side of thinking where they do get short, but you're kind of stuck in a candle like this with a 44-point range, and you kind of get short here when we break this 200 SMA, and it kind of spikes back up on you 25, 35 points. If you're running a tight stop loss, or you're running size that is just too big for this type of condition, it's going to stop you out. And what's going to happen, you're going to get stopped out, and you're going to look back at the chart an hour later, and you're going to see that if you just would have held, you would have made all of this cash. So how do we get around that? We got to control the emotions. How do we control the emotions? By watching the P&L on the screen fluctuate in a much smaller size, in a much smaller number. If your P&L is fluctuating $500 at a time, 500 up, 500 down, 1,000 up, 1,000 down, you're going to feel every roller coaster up move and down move, and it's going to feel like, everything is moving 1,000 miles an hour. If you're trading a micro contract, 2 micro contracts, 3 micro contracts, and you're fluctuating $50, $60, $70 at a time, it's a lot easier to manage that. So when it's easier to manage that emotion, it's easier to manage your trade, because the big picture here is telling us that 15 minutes off the open, not only do we fail to confirm the highs, but we also lose the 20 simple moving average, and we also lose the VWAP. So if we're trading, price action is trading around or below those two moving averages, those two indicators, typically that's telling you that there's a lot of weakness in whatever time frame chart that you're trading. So for example, we're trading the 5-minute chart here, and we're looking at that weakness through that 200 SMA, through the VWAP, and through the 20 SMA. There's a lot of room to the downside here. Now, if you kind of notice this blue line that's dragging across my screen, this is your linear regression channel 50. I do all of my charting on Charles Schwab with the Thinkorswim platform. It's an indicator that you can add onto that platform, and it's very, very good. It's just a standard deviation move away from an average of 50 channels. So it's nothing that's, you know, top secret. If you have the platform, I believe there's a couple other platforms that are out there that offer it. Don't quote me. But what I'm saying is that if I'm using this chart as my gauge, as my rule of thumb, and I'm trading below VWAP, I'm trading below the 200, I'm trading below the 20 SMA, and there's nothing here for support until this linear regression, well, then I have to kind of trust that the stock or the underlier or whatever it is that you're trading is going to want to naturally gravitate towards that next area of demand. Now, there's a couple of other moving averages that I like to use to kind of gauge the momentum on a shorter time frame, on a shorter, you know, kind of outlook, and that's the 5 SMA, okay? So if you notice this green line here, okay, this green line, this is your 5 simple moving average. Some people use the 8 EMA, the 9 EMA, the 10 SMA, so forth and so forth. I like to use the 5. Now, by using this 5, it's going to tell me that if I'm staying below the shortest, nearest term sentiment moving average, that's a power trend. There's no ifs, ands, or buts about it. I do not want to be long if I am trading below the 5 SMA. Okay, if my indicator, my confirmation to go short is loss of VWAP, is loss of the 20 SMA, is a failure to confirm highs, the high of day, and we are trading below the 5 simple moving average, then I need to respect that and I need to remain short. Whether you like the drawdown that you're in as it's chopping around or not, it doesn't really matter. The picture here is black or white. The picture here is that if you are trading below supply, the pressure is down. You must hold, or you must look for those opportunities to the downside. Today presented a fantastic day for the shorts. If you were able to catch that, congratulations. Again, you know, it's been a couple of weeks since I've made a video. Again, towards the end of the year, it's just good to kind of take a break and kind of decompress. But we will be back. We will be back to, you know, normal scheduled programmings where we do a lot more educational videos here at Evolution Traders and here at this channel. But just kind of wanted to step in here because I know it's on days like today where, you know, the market's only down 0.5%. Okay, the market's only down 126%. And if you're trading on the wrong side of things, it can seem like the market is down 20% in a day. It can seem like, you know, you can't seem to do anything right, but you got to slow yourself down a little bit here and just kind of manage a little bit closer.